Thank you, everyone, for coming on online. Alex Wilson, I'm broker owner of Remax Wealth Builders Real Estate. Um, and I have a portfolio worth over $20 million here in Canada with assets between Toronto and Calgary. But I'm always looking for other investment opportunities and looking for rates of return, how to protect my money. And I'm always attracted to the UK because the UK has, well, Canada's system is based on the UK. We are a former British colony, and with a system that's based off of another country's system, that means things are very similar when it comes to banking, when it comes to governance. Also, another thing that Britain has in common to Canada is when you look at Europe overall, Britain is the #1 destination for immigration. It's if people are looking to move to another country, Britain, England is the #1 place that people want and have been moving to. So even with Brexit and everything like that, England is still the #1 place that people are going, and they're hitting record levels of immigration as well. So I see great growth opportunities for Britain, the UK, England, and that's why I've turned my sights to that country. And Ed's got some different product offerings for investment. So the last time we talked about what we're used to is that pre-construction industry, specifically in the Manchester area. And we're going to talk about that a little more in the second half of the presentation. And even to show you the demand, the projects we talked about in the last presentation, those are now sold out. We do have some other new opportunities, but the demand is there for those projects. But you still end up in the similar situation where you're putting money down and you're hoping on appreciation in the future. What Ed has now is that opportunity, which offers that 9% year over year realized return while owning the asset, and you would be purchasing the asset this year. You'd be closing on the asset. So it's something that's really cool. And without further ado, I'm going to let Ed start talking about that opportunity, which I again, there's nothing like it in Canada, and it's really unique. So I'll give the floor to you if you want to share your screen and start talking about that opportunity.
Great. Yep. Thanks, Alex. And yeah, thank you everyone for joining us today. It's great to be presenting with Alex again. I'm going to share my screen and get this presentation underway. Here we go. So very briefly on me, very briefly, I've been in the industry for 15 years, from the UK originally, worked in London for over a decade for a major investment firm specializing in helping international clients invest in UK real estate. We've done thousands of transactions. I have my own portfolio between Canada and the UK, so I've been through both purchasing systems personally, and I've helped clients from all over the world, 54 different countries. The UK is very open. Everyone can invest in the UK. It's one of the great benefits of the systems. And when I came to Canada 7 years ago, I met a wonderful Canadian girl, got married, we moved to Canada, and I set up Finlock Property, which is my firm, which specializes in helping Canadians and other international clients invest in UK real estate. And so Finlock, very briefly, we do very similar to Alex. It's a comprehensive service to help you invest in UK real estate. We cover the whole UK. We provide the management services. We get you mortgages, every step to purchase, to own, manage, and sell the property. We're there. So you can do it all at arm's length, sat at home. You never need to even step foot in the UK at any part of the process. And so it helps you diversify very easily, very securely. And we have the same values of creating long-term wealth for clients through real estate. So why should you even look at the UK? Well, the number one reason would be diversification. Any sound investment advisor is going to advise that any investment portfolio needs some form of diversification, and diversifying through currency and through economy can provide some very good security, very good structure. So you're not solely reliant and exposed to one currency and one economy. And the UK works very well for Canadians because there is a very long history of trade there. It is very pro-investment in both directions. Canada's UK's second most important destination for foreign investment and vice versa. And you've got some of the all the major sort of Canadian pension funds, major institutions, all have some form of holding in UK real estate. But from a private investor's point of view, you've got the diversification, but then you've also got the fact that it's a very secure property market. It's got an excellent history of supply-demand ratio, and you've got some of the fastest growing cities in Europe, some excellent cap rates, some excellent yields, and it's fairly affordable. So you can do it and diversify in a relatively affordable fashion. So as Alex touched on, we're going to I'm going to present two different types of investment opportunity today. What we like to do is we like to segment portfolios into properties that do one principal job in that portfolio. So we focus on income-focused real estate, so real estate that is focused on producing you a good, solid, reliable cash flow into your portfolio, and then growth-focused opportunities, which are focused on the long-term wealth creation and the growth of your wealth in the capital asset form. And that would, so the income-focused opportunity today, as Alex touched on briefly, is the what we call social impact real estate, and that is investing in UK social housing, where you're buying physical houses, freehold houses, and leasing them through the government system so they can use them for social housing. And that's very much income focused. And then the growth focus would be new build condos, pre-construction, as you would be used to in Canada, but in the UK. So firstly, I'm going to discuss the main topic of this webinar, which is the UK social housing investment, social impact real estate, and how that works. So how does it come about? Why does it exist? So in the UK, there is a housing shortage, and that has led to a big shortage in social housing because the government is just hasn't kept up with and is unable to build enough houses for the amount of people that require them. This is vulnerable people or people who need that additional support, and it's led to a waiting list of over 1 million or up to 1.4 million now people waiting, and they are housed, a lot of them, especially the vulnerable tenants, they are housed in emergency accommodation or temporary accommodation at the cost of the government. That's Airbnbs, that's travel lodges, that's hotels, that's hostels, where they're paying per night. So it's very expensive, very costly for the government to do that. But it's also very costly for them to build a load of new houses and constantly be pumping money in. It's a long-term solution that takes a long time to build them, and it's very costly. So one of the main alternatives that they do to create more social housing is lease private real estate. And that's been around for a long, long time. They do it a lot with funds and institutions in terms of blocks of apartments, etc. But they also do it on individual private houses. And that is where this investment opportunity fits, is the opportunity to buy houses with these social housing leases in place. So we've partnered with one of the principal, or certainly the best in our view, social impact developer in the UK, and we're actually invested in them ourselves. And what they do is they go to the open market, generally in the northeast of England, and they're purchasing sort of rundown, poorly managed, underused existing houses in these sort of towns and villages around the northeast of the UK. They purchase them, they then put them through a full renovation, because the government don't just lease any old house. It has to be up to a certain or a very high standard of quality. It has to have fire doors and safety systems, alarm systems, all the electrics have to be up to date. There's a whole host of different checkpoints that need to be taken in order for it to be approved to then be used to house vulnerable people. So they do all of that. They buy the house, they renovate it to the standard that's required. Then they agree these leases, which are 25-year leases, with local social housing providers who are government-funded entities in each of the local communities around the UK. And the government funds the 100% of the rent of that lease through that provider. So when you're investing, you are buying one of these freehold houses, which is the renovation is fully is already been completed. The lease is already in place, so you purchase it, it exists, it's got the lease in place, so you're up and running with your income coming in from month one straight away. And that's how it works. And these are the key reasons of why you would do it. They are just excellent cash flow properties. So you've got excellent fund security because you're buying a freehold house. You have the full title to it. It's your house. You own it from day one. But on that same day that you purchase the property, you're also entering into this 25-year lease with the social housing provider. And that lease is incredibly valuable because A, it produces you a good, strong return. B, it's government backed. So you've got an excellent caliber of tenant. I mean, the security you get from 100% government funded income is superb. And it's hassle free. And when I say hassle free, I really mean it, because it's a commercial FRI lease, fully repairing and insuring lease, which means the social housing provider take on all of the responsibility for the management, the maintenance, the tenant management. They take on all the running costs. So for you as an investor, you simply get a monthly rent on that lease for 25 years with no costs and no void periods. Because they're housing vulnerable people, they unfortunately they won't just rely on private landlords to do what they need to do and upkeep the house and keep it secure, etc. They take on all of that because they need to be providing high levels of care to these tenants, and they are also providing additional care services to support them as well. So you purchase the house, they lease it, and they take on all the responsibility and pay you a rent for the benefit of being able to use that for social housing for that 25-year period. The other value of that lease is that it is index linked or inflation linked. So every year there's an inbuilt increase in that income. So it increases every year. You don't have to negotiate with a tenant a rent increase. You don't need to worry about increasing costs. It is linked to CPI, the Consumer Prices Index in the UK, which is essentially inflation. And it will increase by that amount each year. There is a rent review. So it goes up every year to create some inflation-proof income as well. And last but certainly not least, one of the reasons that we are so passionate about this and why it's such a beneficial investment for so many different reasons is that it's really ethical. You are having such a positive impact on the lives of vulnerable people. So it's not every category of social housing tenant that the government funds 100% of the rent on. It is only people that fall into a vulnerable category. And so that's the leases that we do, and that's the leases that the social housing providers and the tenants are involved in this investment model. So there's a whole range of them. They can be victims of domestic abuse, asylum seekers, people with learning difficulties, mental health challenges, and the homeless is another huge category. The people who need additional care services as well. So to look at it, what this looks like, to give you an example, most of these houses are located in the northeast of the UK, sorry, northeast of England, I should say, for various reasons. One, the housing is very affordable, so it becomes so your rates of return are very attractive for investors as a significant reason. Secondly, the demand for social housing is very good up there, and so that combines a good investment return with a strong positive impact, which are the two key values of this model. So they are generally, we're doing about 10 to 15 of these a month, and they're generally 2-story, 2-bedroom, freehold, terraced houses, 700 square foot, but it varies depending on house to house. They have private yards. They're great little cozy homes for people to get started. They already exist in the market, in the residential market. And they have to be within walking distance, or certainly within easy reach of all the other care facilities and services that are required for these types of tenants. It will be fully renovated, of course, and it comes with that 25-year lease to the government-funded social housing provider from day one. So these houses in this area of England, we can deliver them for £93,000, outright cash purchase. That's the full purchase price, £93,000 for a 2-bedroom freehold house, which is the equivalent of about 160,000 Canadian dollars. And the government pays £700 a month rent, funds 100% of that £700 a month rent in year one, and that equates to a 9% net return. So $1,200 a month, just over $14,000 a year on your 161,000 purchase price, and that's for 25 years, and it's inflation linked, index linked. So this next table shows you or illustrates how your income would increase at these 5-year milestones. It increases every year, but I didn't want to put 25 years of income there, so it just shows you the milestones. But this is based on a 2% average annual inflation rate, which is the government's target. But if it's more, you get more. If it's less, you get less. But this shows you 2%. So you're at 9% net year one. That's at $1,200 a month. But by year 10, you're almost at 11% net yield on your original investment. Year 25, you're almost at 15% net yield on your original investment, and that's the value of this inflation linking within the lease, and getting almost $23,000 a year net income. And so over a 25-year period, so over the lifetime of that 25-year lease, you're earning $464,000 just through the income on your $161,000 investment. And all that time, you still own that freehold house, which has the intrinsic value and will grow over time as well. But that is not the key focus of the investment. The focus of the investment is the strength of this return and the provenance behind it, that it's funded by the UK government, and that it's hassle-free. And it's a really, really valuable asset for multiple reasons to get into a portfolio. It's great for those who have a heavily leveraged portfolio or heavily growth-focused portfolio, who want an asset in there that can just provide some stable cash flow to ride out void periods or increasing mortgage rates or whatever might happen. To have consistent cash flow in there is very, very useful. Also, if you're looking to shift more, if you're coming close to retirement and you're looking to shift more from a growth-focused model to an income-focused model, these can come in very handy to use that capital and produce greater income. And also for those who are looking to ease off the reliance on salary and become a bit more financially independent, produces some great cash flow to help you achieve that as well. And like I say, you will get growth with it over time as well, but that is more just an underlying security for your funds, and a bonus of whatever growth might come. It's the income that is the key focus of that type of investment. Plus, the underlying values and ethical side of it, that you're really doing well for yourself, but you're doing real good for other people out there. And so many positive aspects to this style of investment. We're very, very passionate about it. We invested in it ourselves. We're invested in the developer, but we're looking to roll this out across the whole of the UK. So that was the income focused one. I'm going to touch briefly on the growth focused opportunities, which is much more what you're used to doing, I'm sure, in Canada, where you're investing in pre-construction, new build.
And I just want to jump in quickly. So
Yeah,
a couple of things, and I think it's important because we talked about this before.
yeah,
Number one, this is a cash outright purchase, so these are not mortgageable. So if people are wondering, so when Ed puts that number of 161,
yeah,
you'd be providing 160, and when I'm saying Canadian dollars, 161,000 Canadian dollars for the specific example. So you're not mortgaging these. They're
correct.
they're full cash purchases. Number two, you can still sell these. You still have the ability to sell these. Ed can help in the facilitation of these. So there's an asset value to sell them. The lease is in place. The lease doesn't change in 25 years, but you can sell that asset, that the ownership of that asset, someone else that may be looking for a specific return. So Ed, do you want to
Yeah.
talk a little bit about that in regards to just if someone does want to exit before 25 years?
Absolutely, yeah. It's a very good point. So yeah, so because you own that house at all times from day one and forever, it's your freehold house that you can keep, sell whenever you like, or keep it, pass it down generations as your UK house. So yes, during a 25-year lease, you can exit at any time. We do the full resale service for you. Or you can sell through local agents in the local market. They will also take them on and sell them. So you have multiple exit strategies. During the 25-year lease, you would be selling on to another investor who's investing for the same reasons, for that secure income. They inherit the remainder of that 25-year lease. And so you can do that at any point. And it's a very, very popular model. So the resale is never much of a challenge for us. In fact, the biggest challenge for us is actually getting enough properties to be able to run this model and create the volume. So any resales that we can get, we're genuinely very grateful for.
And I'll jump in as well when Ed
Mm,
and I a month ago started talking about this current webinar. Ed was like, "Yeah, I just don't have any property, so available
yeah,
on the program." Like, well, we'll still go ahead with it. I know you do have properties now, but they do sell out fairly quickly because it's not like Ed is building or the developer partner is building a brand new tower. It's you have to identify the property, rehabilitate the property, and then go to that. So there's a scarcity to these. So there is, which creates a market for them on a secondary market if you choose to sell these. But the people buying these are looking for long-term stable cash flow to potentially offset some of the growth opportunities. Another quick question I want to jump in on. When you show that monthly income, there's no additional expenses beyond that because that's already been factored in because property tax and those types of charges, those are borne by the individual purchasing the property, correct?
uh, correct. Sorry. So when you're in terms of your purchase costs, you have two purchase costs on top of that price. You have stamp duty, which is your
Yep.
purchase tax, and you have your solicitor's fees.
Mhm.
So you do have those two costs on top of the $161,000
Yep.
price we put in there. That it's going to be about $6,000. It's not huge, but you have that additional cost, and then the running costs you have zero. The only responsibility you have is to insure the building. You have to get buildings insurance, which we arrange for you, and you pay for that up front each year, but you get refunded that at the end of each year. So it's a net zero cost, but it's the only,
Even that. Oh, that's even better.
yeah.
Great. Yeah,
So
yeah.
it's
So I just wanted people to clarify because a lot of times they see that number annual income, like, well, what do I have to take off of that? So I just wanted
yeah.
to clarify to everyone,
Uh,
there is nothing to take off of that.
Correct. There's nothing to take off it at all. That monthly rent is a fixed monthly rent. That is it. There's not a single cost to come off that. Just to clarify also on the exit, so that's during the 25-year lease, you would sell on to another investor. But at the end of the 25-year lease, this is a residential property. and in which case you can sell that on the open market at open market residential value, and then you can make a load of money that way, or you can use it, or you can live in it, or you can rent it short-term living. You can do whatever you like with it at that point, or you can renew the lease. And so you have two exit strategies. One, if you need to sell within the 25 years, you sell to another investor, or you wait until the end of the lease and you can sell it on the open market. So both are open to you.
And then one other question that we had here, and I just wanted to handle these before the end because we're going to a different topic where we're talking
Yeah,
about
absolutely.
opportunities. Can anybody invest in this, or does it have to be a Canadian citizen?
Oh, anyone. Yeah, anyone from around the world. Yeah, we have investors from 54 different countries and a ton of UK investors. So yeah, anyone can buy real estate in the UK. Yeah.
So yeah, and the reason for that question is us Canadians are now, it's illegal for anyone that's not Canadian to buy in Canada. The
That's
UK
right.
does not have those restrictions.
No,
And,
anyone can buy. Yeah.
and they will never have that type of restriction. That is never going to come to England, the UK. They're not going to restrict ownership to British residents. That's not going to happen. There are too much inflows of internationals that come into the UK. It's a global financing hub. That won't happen.
Yeah, highly unlikely to ever get passed through government. I would suspect it is how the UK has really built its economy. It's a huge influx of foreign investment and its sort of central location in the world, and the pound currency is where the foreign money comes in.
And let me just look at the question, see if there's anything. How much do these properties generally increase in value by?
So good question. And it's kind of linked to the exit. So during the 25-year lease, it gets valued more on a commercial basis of the value of the income, because you're going to be selling to another investor, and they're buying it based on the income. The value is determined by what yield they're going to buy that property at. So you can use we use a strategy called yield compression. Without getting too complex, it's essentially as your yield increases, as your rate of return increases. So if you look at year 10 there, you're almost at 11%. You can then sell that asset on to another investor at a slightly higher price, offering them a 9.5 or a 9% yield. You can get some growth out of it, and you're still offering a very good rate of return. It's still a very attractive investment with another 15 years to go on that lease to another investor. Or if you really just wanted to sell it quick, you sell it at the same price at an 11% yield, and you're going to sell that in a couple of days. So that's how the value of the property works during the lease. But in terms of the underlying residential value of that property and what it will be worth in 25 years' time, well, that will obviously follow market trends. But over the last 25 years in this area of the northeast of England, the price of freehold terraced houses like these has gone up over 200%. So if you factor that into your returns in 25 years and selling it on the market at 200% return growth there, then that really amplifies this investment. But we tend not to focus on that with our investment analysis, because it's so income focused in those first 25 years. But as a long-term security, it's very valuable, your underlying asset.
Yeah, and I'll also add to, and Ed discussed it, we're talking about yields, and when you get into the commercial yields and you look at that, when you actually see interest rates start going down, these yields become more valuable, and that's where you see the value of the asset will go up, because as interest rates go down, cap rates, the cap rate you value it at will go down as well. But that actually is an inverse in regards to the valuation of the price. So not to get too complicated for people, but as rates go down, the yield gets more valuable, because savers get less money for saving their money. Right now, with interest rates high, savers like that. So that's where you can get GICs at 5%. That won't exist next year, because interest rates will be down, and you'll get a lower GIC. But because these yields are fixed yields and go up over time, and which Ed did it at 2% inflation. So that's it's modeled in regards to historical rates of inflation, not in regards to where our jumps are right now. The underlying value of these assets will go up due to the yield and decreasing interest rates. But we don't discuss that on these because it gets really complicated when you get into the valuations of properties based on yields and everything like that. And as Ed says, you got to look at the cash flow opportunity. You're buying this for cash flow. And now the questions are rolling in. 9% is minimum we'll get throughout 25 years. If yes, then ROCE will be paid within your initial investment will be paid out in 10 years. I haven't done the math, but I think the return on equity is 10 years, right?
It would be slightly less. Should be about 8.5 years. Yeah.
Yeah,
Well, unless I mean, if it stays at 9%, doesn't increase with inflation, then this would take you slightly longer than 10. It depends how quickly inflation goes up, but it will be within 10 years for sure.
Yeah.
Even at 2% inflation, it would be within 10 years. Yeah.
Yeah. How about the tax every year? Who pays the tax? If you're referring to income tax, any income you make, there's tax on the income. So when we say net return, oh, go ahead, Ed. You're gonna say something?
Well, so I was going to say, with regards to tax, if it's property tax, then yes, not your issue. That's covered through the lease, so you don't have any property tax to pay. And as I'll come on with the growth options, property tax in the UK is actually paid by the tenant anyway, even in a private residential let. But oh, sorry, I lost my train of thought there.
Income tax. We're getting income
Income tax. Sorry, yes, income tax. You've got two. If you buy it in your personal name, then the Canadians are taxed on the worldwide income, so it would just fall under the same category of income tax you pay on any other income you get in Canada. You just declare it on your tax return, and that's that. You pay that rate of return. But you can purchase these in a UK limited company and get the income through that, and then you're paying corporation tax in the UK only, which is 19%. So you can really minimize, it's one of the lowest in the G7. So you can really minimize your income tax because you put the money that you put into that company, the 161,000 or slightly more with the costs, that is your shareholders' loan to that company. So when you're withdrawing income out of that, there's no tax to pay on that income because it's a repayment of the loan. So you're just paying the tax on the profit within the company, which is 19%. And so it can be very tax efficient to do it that way. And we can set up that company for you within a few days and a UK bank account, etc. So you can ring fence it all over there and make it tax efficient for you.
And also adding to people that also when we talk about hedging against your currency, now you have that account over there that's tax efficient, that's also in the British pound. So now in regards to your Canadian currency, you're hedged against that with the British pound, and then you have your account over there in a first world safe country that you know your money isn't going to disappear in. And that answers Stephen's next question. Can you buy the property within a corporation? After the way Ed described it, I highly encourage you to buy it in a UK corporation because that sounds incredibly tax efficient.
Yes, but I just to add to that, if they're referring to buying it within a Canadian corporation, that is a bit more complex. It can be done, but really you have to jump through a lot of red tape with UK anti-money laundering rules. You have to register your Canadian company also in the UK. You have to go through that process first. All gets a bit complex. If you really want to, it can be done and we can help you do it, but you probably get more benefits or at least the same benefits by just setting up a UK company and keeping it separate. So generally 99 times out of 100, that's what our clients end up doing. Yeah.
Okay, here we go. One more question in terms of payouts. Do we have to open a bank account in the UK or will money be deposited in Canadian bank account?
It can be sent to a Canadian bank account. Yeah, that's fine. Again, you probably want to set up a UK account so that you can send it across to yourself when the exchange rates are more favorable, or you can at least build up your pot there and send it across. Because if you get it direct to the Canadian account, you're going to pay banking charges, etc. each time. But it certainly can be done. The providers will pay the income worldwide. So yes, you can do that.
How much do we have to pay out the door? This would be the 161. And I think you mentioned there's stamp duty, that kind of thing. So, and
Say
solicitor fees, you're looking
107,
about 6,000
say
Canadian dollars.
170 round figure, and depending on the exchange rate, it'll be around that figure, total capital in. Yeah.
Okay. Is monthly rent paid in Canadian or pounds? It's paid in. So this goes back to opening an account. The rent would be paid in pounds. So if it's directed to a Canadian account, they convert it to Canadian dollars. That being said, and I agree with Ed, I would have it in a British account, growing in a British account, and then if you need to take money over back to Canada, you'd be looking at, okay, when's a good time for the differential. So for example, if we go just talk about a specific time, um, was it last year when there was the shortest prime minister in UK history?
Yeah, a year before, yes, but yes,
The
yeah,
yeah, 2 years ago, and there was something that she put into to effect that caused the currency to go like this.
yeah.
And at that time, Ed saw a boom in business because people were flooding in, going, "Hey, the currency's down. We want to load up on British assets." So at that time, that would have been a good time for you to take money out of the no, that's the opposite. You want to put money in.
By the
It's
way,
a good time
yeah.
want to put money in, and then once things change, the pound shot back up again. So you're just watching for
That's
different.
right, and it's an additional potential return you can get from
Right.
an investment overseas, as you can play the currency to a degree, and wait and just snowball that money in the account until the exchange rate's good and it's worth even more to you when you send it across.
So if you buy within a UK corporation, the tax is 18%. Can you then withdraw those funds personally as Canadian income?
Yes, so it would be what it would be determined as a repayment of a shareholder's loan. So I believe you can do the same in Canada,
Yeah.
where
Yeah.
you
Would you? Yeah.
essentially the money you put into the UK company, you are loaning that company to buy the property, and then when you're taking the income out, it's not shown as income; it's shown as that loan being repaid.
Correct. Yeah. So
And
yeah.
yes, you can do that. You can do
Yeah.
that
So
from a UK corporation to a Canadian resident because you're the owner of the company. So yes, absolutely, clients
yeah.
do that all the time. Yeah.
Yeah, so Stephen, so for example, that 161 plus 6K or whatever, let's say 168,000 that you put in, that first 168,000 you can withdraw from that UK corporation. There'd be no tax impact because you'd be repaying yourself in that case.
Correct.
Is the income tax paid in UK or Canadian? I guess I'll let you. It depends how you have it set up. If you have it in the UK corporation, you're just paying income tax in the UK. If you're owning it personally in your own name, then you're paying income tax in Canada as worldwide income. Is that correct, Stephen?
Uh,
Ed?
yes and no. So if it's through the corporation, then it's not technically income; it's shareholders' loan repayment. So that's separate. But with regards to income tax, if you earn it in your personal name, then you will pay some tax in the UK and you will pay some tax in Canada. There is a double taxation treaty. I don't want to get into too much detail, but basically the first £12,500 that you earn in the UK, you can get the UK personal allowance, which is a tax-free allowance. So the first £12,500 you earn in the UK would be tax-free. And then you would pay tax on top of that. However, Canada may still charge you some income tax on that for your worldwide income. But with a double taxation treaty, you shouldn't get charged any income tax until above the £12,500 income threshold. Yeah. But I can go through that on a case by case. That's
Yeah,
fine.
exactly.
Yeah.
If you're interested, then we'll get more into detail, like not in this, but that showing you the return and how the taxes are paid on that income.
Mhm.
Then so well, what I would say, and then answer this, and then maybe you correct me, after the 161,000 is paid, so we're not repaying any more shareholder loans. What happens? From the corporation, you'd be just taking a dividend, taking that into dividend income. I'd be
Yes,
assuming you're just taking a dividend
exactly.
from
You
a
just pay
UK
it as a
company.
dividend, and it comes in as your worldwide income, and you'd be
Yep.
taxed accordingly at that point. Yeah.
Yep. Okay, yeah. So that's just continuation of that question. So once you pay back the 161,000, whatever you put into the UK corporation, you would then be paying yourself out a dividend payment from the UK corporation, just like if you owned a company in the UK that paid out dividend shares. It's the same thing. Same thing in Canada. If I'm paying from a corporation, I'm paying myself out a dividend, then you're just paying the worldwide income at the dividend tax rate. So.
Yeah,
But again, if
exactly.
you're interested, we can get into more, not right now, because that could be a 45-minute conversation. But if you're interested in pursuing one of these investments, I can book a call with you and go a little more into the taxation.
Yeah, and we have accountants that will give you advice and set it all up, and that can all be done as efficiently as possible. Yeah.
Yeah. So what we're gonna do is we're gonna go continue on now, and we're gonna go into the growth. So let's say you're like, hey, Alex or Ed, I'm interested in growth and income. If you do both of these, you can do both. So if you're in a growth-based asset that doesn't have as advantageous cash flow, you can invest in one of these, which is going to create cash flow and offset uh, uh, the cash flow, potential negative cash flow in a growth-based asset in a new build. So we're going to get into talking about people investing in new builds, and we have clients that are interested. Hey, Alex, we just like putting deposits down and getting a new build in 3 to 4 years. That's kind of our cup of tea. So we wanted to, instead of breaking this into 2 different seminars, we wanted to handle them both, because I know people being interested in new builds as well, and that's what people are used to investing in. So Ed, I'll let you talk about new build opportunities.
Sure, thanks. And yeah, and there's great advantages to both of them depending on your strategy and where it fits best in your portfolio. So for sure. So yes, new build. So here we are, investing in off-plan condos, new build properties in the UK works very, very similarly to Canada. Where do you want to invest in the UK? We focused on this in the last webinar, so there's a bit more detail there, but Manchester is really the #1 city to be investing in the UK, and I would say in Europe for sure. It's in the north of the UK. It's called the capital of the north because it's the largest economic area in the north. London, obviously, being the largest in the south. A third largest city in the UK, and it has the largest UK airport outside of London. So you've got 210 direct destinations that you can go all over the world there. So it's very, very globally connected. And so you've got London, the capital of the south, and Manchester, the capital of the north. And the big fundamental shift that has happened and is happening in the UK is the diversification away from London, which is very, very significant for the UK as a whole. The UK's always been very London centric, and now it's not. The government has got this Northern Powerhouse investment, £250 billion that they are investing in the northern region, of which Manchester is the capital and the epicenter and the main beneficiary of all of that investment. And along with that comes huge foreign capital investment and other corporate investment from within the UK, and I'll come on to that in a minute. So that started in 2014, that investment, and is running to 2036. So we're just under halfway, about 10 years in. And in that time, the Manchester economy has grown at twice the speed of London's, and for very, very good reason. It's now reached a size of 83 billion, an economy of 83 billion, which is a similar size to Vancouver. And it's a very, very attractive city. Always has been, culturally, with music and sport and all the innovation that they've created there, the first computer. But it's very affordable. So your cost of living and your cost of doing business is almost half what it is in London. And so all of that has culminated in this incredibly exciting, incredibly growing city, one of the fastest growing cities in Europe, the fastest growing tech hub in Europe, because all these big companies now are also diversifying away from London. They're not leaving London necessarily, but they are setting up major global offices in Manchester as well, or instead of London. So now you've got 80% of the FTSE 100 companies in Manchester. 15 years ago, nowhere near. Now you've got 80% of them, the 100 largest companies in the UK. You can see the names there, the biggest global companies in the world. They all have a holding in Manchester now, the largest financial services centre outside of London. And through this, all of this investment that's going on, you've got another 200,000 jobs that are set to be created over the next 10, 12 years, and another 37 billion pounds of economic growth predicted. That's from Oxford Economics, these stats. So there's a huge, it's done very well in the last 10 years, but we're still only halfway or not even halfway. So there's a lot to go. And as a result of that, you've got, it's transformed this city into a very, very, very desirable place, and where everybody is going to live. Most livable city in the UK 2023, and that's, you know, multiple awards for that, but that's the most recent one last year. The population is growing at twice the average of the UK. And one of the other key fundamental shifts that goes along with this investment is that London is a very expensive city to live in and do business in, and, you know, rightly so. It's a very, very important global city, but it's at the point now where it's very, very expensive for young people to live, to try and get on the housing ladder. All of those challenges that are similar to Toronto in many ways. So those and cities like Manchester are huge educational hubs. So they've got 5 major universities, over 100,000 student population. And it used to be that the students would get these great degrees, become highly qualified, have a wonderful time at university, wave goodbye, and get on the train 2 hours down to London. So another point is London and Manchester, okay, they're the capital of the north and the south, they're 2 hours away on the train, you know. So you're not traveling hours and hours and hours. And so now Manchester's retaining over 50% of those graduates. So it has this inbuilt, highly qualified workforce every year that's coming out, driving that economy, and also creating that strain on the rental market. And so that's obviously led to a huge rental demand that the housing supply just cannot keep up with. There's this huge influx of people coming in, which is a great sign for real estate investors. You can see the stats there. Rental inquiries have more than trebled in the last 5 years. Every property that's on the market, you have 30 inquiries for that property through the door on day one. And Manchester is full. Every property is full, and you've got a huge demand as it grows. And that, of course, what you're looking for in real estate is supply-demand ratio. Are there more people wanting to live, more people wanting to buy than there are houses? And in Manchester, it's amplified more so than any other city. You can see again from Oxford Economics that chart there of the housing supply and demand ratio. At the speed that they're building houses at the moment in the current pipeline, we're going to be 82,000 homes short in 7 or 8 years from now. And house prices since this investment started have doubled. 10% annual house price growth over the last 10 years. That means, and it's still half the price of London. So there's still so much value to be had. There's so much growth still to come. So our clients who bought 10 years ago, or anyone who bought in Manchester 10 years ago, if they bought in cash, you'd have doubled your money now, regardless of the income, just in the asset value. But if you use leverage, which you always want to do if you're looking at a growth focused investment, you amplify that return by 4 times. If you're taking 75%, you're only putting a quarter of the price. You're getting 400% return. So clients have done very, very well in Manchester, but we are just getting started. So how do you maximize your return from the UK? And there are some key advantages here, some key differences that allow you to create cash flow as well as growth with the UK market. So as an international client, you can borrow and you can take a mortgage from a UK bank. There are hundreds of lenders. It's a very, very mature market. And one of the key differences and one of the most attractive features is the prevalence of interest-only mortgages. You can take repayment mortgages just like you do in Canada, but in the UK, the majority of investors will take interest-only mortgages. And what an interest-only mortgage is kind of what it sounds like. You would just pay the interest on the mortgage. You have no responsibility, no requirement to repay the capital until you sell the property or you take a new mortgage. So throughout the term that you sign up for, your mortgage payments are so much lower because you're not repaying the capital. You're just paying the interest. And so that allows you to get positive cash flow out of the property without sacrificing the growth. As the property grows in value, that's still all your gain because your loan amount doesn't change. So you still get the gain, but you have much freer cash flow. And that's the real value of interest-only financing. It also makes it easier to qualify because the debt that you're servicing is just the interest. So that's a lot lower. So it's a lot easier to qualify for. You can, with leverage, of course, you can grow your portfolio by remortgages. Because as that property grows in value, you can release equity from that by remortgaging and use that growth, take some of the growth out, and use it as a down payment on a new property, and you can grow your portfolio exponentially using that strategy. The other differences in the UK market, or the other advantages of the UK market that help you maximize cash flow, is that, as I touched on briefly, the tenant in the UK is responsible for paying the property tax, which we call council tax in the UK. So that is one cost that you do not have as a landlord in the UK. So again, that helps you to boost your cash flow. There's no rent control, so you can increase your rent every year to keep in line with inflation and keep maximizing your return. And yes, we organize a full management to organize all of that for you, so you can do it at arm's length. So now we'll just look at a couple of example opportunities that are available right now that illustrate and show how you can put this into practice and what you can do with your money now. So this is actually, just to put this one back in, this is one that we presented last time. That is now, there's about a dozen units left. So it's the last opportunity. So well done to everybody who invested in it. It's been phenomenally popular. It's completing in 18 months. So it'll be sold out well in advance of completion, a year and a half before it finishes. I wanted to present it again because I love it, and it is one of the best value opportunities in Manchester or in Europe to invest in a major growing city. It's just slightly to the south of downtown Manchester, where Manchester United football stadium is, Trafford Cricket Ground, which is International Cricket Stadium, and Trafford Business Park, which is one of the largest in Europe. Manchester has a great Metrolink system, like a subway system. And this it has two stops there actually that are just a 5-minute journey downtown. So you're very, very close to downtown, but you're not paying downtown prices. So you can invest there from 365, the equivalent of 365,000 Canadian for a 1-bedroom condo. You can see the payment plan there, 10%, 6 months later, and then that 5% on completion, it forms the full 25%, and you would take a 75% mortgage for the completion based on this scenario. And you've got your costs there. So your total capital in between your 25% deposit plus your costs is $126,000 spread over that 18-month or 24-month period. And if you look at those two highlighted figures, the first two highlighted figures, that shows you the difference between your cash flow on an interest-only mortgage and in a repayment mortgage. So that is exactly the same loan size, exactly the same interest rate on exactly the same property. They're identical, but on the first one, you're only paying the interest on the mortgage. So the rest of your income is income to you. On the repayment mortgage, that's just the same as in Canada. So that income is all going to repaying the capital. And that really shows the value of an interest-only mortgage. It gives you the freedom to create cash flow and choose what you want to do with that cash flow, because you still have the option to repay the loan with that money, should you wish. Just because you're not required to doesn't mean you don't have the option to. So that free cash flow that you generate, you can use as your own income. You can build that up into another down payment for another property, or you can still repay the capital should you choose to whenever you wish. And so you have that flexibility and that freedom to do with as you wish. Or you can do the normal repayment mortgage and just have it pay down the capital as time goes on. And so looking at the 10-year picture of that, you've got your 126,000 you've put in total. That's your full capital that you've put in to purchase it, including your cost. Then you're looking at the 10-year combined return. That's the cash flow that you produce, whether that be free cash flow with interest-only mortgage or the funds going back in to repay the capital, plus growth, and we've done 5% a year. So remember, Manchester's been growing at 10% a year. We're doing 5% a year, just as an illustration. That 126,000 is going to turn into 315,000 in 10 years' time, the 250% increase, an average of 25% a year, which is a phenomenal return. I'm going to take a look at a second opportunity here, which is your prime downtown opportunity, which is really exciting because this is the largest urban regeneration in the whole of the north of England, £4 billion regeneration in downtown Manchester. It's part funded by the local government themselves, and then two of these major developers. It's just getting started. This is one of the first buildings to be built, and you're getting in right at the beginning. There's a river that runs through Manchester city centre. This is a riverside development. So it's built all the way up along the riverside, creating the largest urban green space in Europe is what they're aiming to achieve. So you can live downtown Manchester on the waterfront in green space in this incredible community where they're building a ton of facilities. They have a separate building just for facilities or amenities, I should say. And they've sold out of the one beds actually so far in this building. They went almost in the first 5 days of it launching, but there's some great 2-bedrooms there. And there the price is slightly higher because you're downtown, but still, I mean, you're looking at a 2-bedroom condo, £365,000. The equivalent of this in London, it'll be 1.5 million. I mean, the disparity is just phenomenal. And so it's about 630,000 Canadian equivalent. It's a longer runway to completion here. So 2027, so it's 3 years until completion, and being a developer will probably go a little bit longer than that, the way it goes. So say 3.5 years. And your payment plan there, you can see 10, 5, 5, and 5. That creates your total 25% down payment. You complete again with a 75% mortgage, interest only or repayment. And again, looking at those two highlighted figures, that net cash flow on the interest only, that almost $10,000 there, that's after, these are net cash flows. So that's after all your running costs. That's after your condo fees, which we call service charges. So it's after your service charge, after the full management fee for a management agent to, and when we say full managed, it is fully managed. They find the tenants for you, they look after the tenants, they deal with the maintenance, they manage the tenancies, they renew the tenancies, they do everything. There is nothing that you need to do apart from say yes, no, every now and again, and that's it. And so those cash flows are after those costs, after everything, and after your mortgage payment. and you're still producing almost $10,000 free cash flow on top of that, because the cap rate here in this project is around 7%. So it's a very strong yield that you can achieve in Manchester. And then again,